The good thing about the last few weeks is that we have seen the economy become the main topic of discussion. This is, I think, what we have always wanted to have a conversation around the economy. We were hoping that policymakers would begin to engage economists and engage the private sector. We're also hoping that Nigerians will begin to speak up, as everyone else does, on ideas that we think need to be given a chance and implemented, because we are in a crisis. And there is, after all, something called crisis economics. So I'll make a few broad comments. I'm not going to say anything that is worse than has been said by the panel, even though it's coming from me. But I think there are a number of positives. So let's look at Governor Obi's comment about the finance minister and the governor of central bank speaking at cross purposes. I personally thought it was a very positive thing. To be honest, when the fiscal authorities and many people in private business said they wanted a lower rate of interest, I was concerned that the central bank would succumb to pressure. And the fact that the central bank did not says to me that the central bank is beginning to reclaim its independence, which is a very good thing for this economy. And these are economic questions, and you make choices, and you can. And while I'm not here to say this is right or this is wrong, as an interested party, as a former central banker, I can see exactly why the central bank was not willing to lower the rate of interest at this point in time. And let me try to explain this. If you lower MPR by 100, 200 basis points today, it is not going to lead to a rapid increase in credit growth. It's not. I mean, forget you will not see an increase in credit growth that will reverse a downward trend in output by lowering MPR by 100 or 200 basis points. You would, however, further fuel inflation, and you would reduce the yields on fixed income at a time when you're trying to attract foreign exchange. The immediate oxygen that this economy needs, because before you talk about the long-term structural issues of power and refinery, and I hear the chairman about investments, you do need foreign exchange coming into this economy. And the portfolio investors are important for that. And the way to do that, and the truth is, 2 or 3 MPCs ago, as far as I'm concerned, in terms of on paper, the central bank got the decisions right by saying, 1, we will go to a flexible exchange rate, and 2, we are tightening monetary policy. Now, what needs to improve is the improvement. Do we really have a flexible exchange rate? That is what we need to look at. Okay? And if we make those improvements, and these things require courage, because some of the decisions you would take when you say, let the market take decisions. So the decisions you would take would seem to fly in your face in the first week or 2. But look at the numbers, look at the fundamentals. The Naira today is undervalued, okay, if you take PPP. The Lagos stock market, you've looked at all the asset prices, PE ratios, you've got gross undervaluations. The fixed income is offering a high yield. So what does that tell you? If you allow people to actually come in with their dollars and sell at whatever rate people want to buy, people see that they're going to make huge profits on fixed income or on the equities market and on currency appreciation. And you have liquidity into the market. Now, so long as you don't allow that, you're not going to have the flows that you want. Now, it's the inflow of dollars into the economy that will move the Naira towards its fair value and get to where you want it to be. It is not by fiat. The market does not accept orders. You don't sit down and say, this is where I want the Naira to be. It will never happen. It has never happened. Achiampong tried it in Ghana. Okay, we've seen it in Venezuela. We saw it in Zimbabwe. If you don't have dollars in the system, your naira is weak. Simple. So the question is, how do I attract dollars? Now, are portfolio investors the final solution? No, they're not. But, you know, anyone who thinks that a long-term investor is going to take a 10-year, 15-year risk on an economy if the investor believes that we don't have short-term macro decisions right is wasting his time. You have to have the macro right. You're not going to have the World Bank or the IMF lend money to you. You're not going to have banks invest in your bonds. You're not going to have people commit to 10 years, because at the end of the day, people are looking at this huge gap and saying, what is the chance that if I come in at this rate, I'm not going to take a very big hit if there is a devaluation going forward. So the good news is, if you look at the last 2-3 months, there has been a learning process. There has been a retracing of steps. What we need to do is understand what exactly is the macroeconomic framework within which we operate. What is it that we seek to achieve, and what theory advises what we do. So the central bank, for example, keeps high rates of interest, and it's very clear in its mind that it's keeping these rates up in order to keep yields high so as to attract dollars, and with that help stabilize the currency and improve liquidity, and with greater inflow of dollars, have more availability of dollars, and then more raw materials to, in other words, reverse, basically step by step, all the missteps that have been taken in the last 15, 18 months, okay, and basically get capital back. And at this point, I think we need to understand that and encourage that, but we need to also encourage the central bank to have the courage to take that risk of implementing that document, actually going into that flexible rate. Let the market work for a week, 2-3 weeks, and see. As people find that they can come in, sell their dollars, buy stock, sell their dollars, buy fixed income, okay, make a profit on capital appreciation, make a profit on currency appreciation, you're going to have a gradual narrowing of the gap between the interbank and the parallel rate, and you're going to have more liquidity in that segment. This is my conviction. Now, in terms of the broad economic fundamentals, again, we're in a very difficult moment, and difficult decisions have to be taken. So I'll give you an example. Government revenues have been hit very badly by decline in oil price. They've been hit very badly by the activity of Niger Delta Avengers, okay, and the reduction in output. The instinct of government, the instinct of fiscal authorities at this time is increase taxes. Get rid of incentives because you want to improve government revenue. Now, at this point, it's extremely important to look at the numbers. If you increase the tax rate, or if you remove certain incentives that have been given to private investment, how much are you going to raise? How many power plants will that build you? How many kilometers of road will you get? How many airports would you get for that money? 20, 30 billion, 40 billion, I don't know. On the other hand, if you decided to forego some of that income in the form of incentives, how much can you attract in private sector investment into those areas? Now, my sense is that you need to get away from a mindset where government raises money to build the roads, raises money to invest in agriculture, raises money to build airports, to a mindset where the government says, what kind of environment can I create? What kind of incentives can I create to allow private sector people to come and build this for us? And that's extremely important in terms of getting investment. And once it is clear that this is the mindset you're working on, looking for private capital to come in and build your power plants, build your refineries, build your roads, build your railways, modernize your rail system, while you focus on public health, on education, on technical and vocational skills, on salaries, which have to be paid because you need to continue having your consumer spending anyway. Then you begin to have a conversation that is fruitful, that is positive, and that everyone can relate to. So I suppose my word of caution is that in a time of crisis, you can panic and take a decision that looks very smart short term, but that hurts you long term. The decision to protect the nominal value of a currency was at the same time a decision to allow the real economy to take the hit, because it's a shock. That shock has to have a shock absorber. You either absorb it on, and this is macro theory, you either absorb it on a nominal variable or on a real variable. The decision to protect nominal variables meant that you took it on the real economy, plus you do not necessarily protect those nominal variables because inflation today is at 18%. We would not have been there if we had not made that attempt to protect that currency at that level. So, but that has been done. It's not a disaster. It's not that we cannot get out of. And I think the fact that we have shown a willingness to reconsider means that we are moving in a general positive direction. The final point I'd like to make is, while we look at the missteps and the errors, it's always important to remember two things. First, there was something fundamentally wrong with the model of growth that we've had over the years. And this was the point I made in my discussion with the ministers of planning, which was missing in the newspaper headlines. Nigerian growth has been driven by two pillars, and this is true of many African countries in the last decade that was called Decade of Africa Rising. The first was rising energy prices, and the second was rising domestic debt that went into consumption. So real wages basically kept increasing. We got to a point in 2011, I always say, where with oil price at $110 a barrel, we were spending 80% of government revenue on personnel costs. I mean, this is not new. This is something that I said as governor of Central Bank. I said it was unsustainable. I said it was a problem, and nobody listened. Now, that model has reached the limit of its capacity. There's a limit to how much you can borrow and spend. Okay, now you're spending 40% of your revenues on debt service, you can't borrow anymore, even on domestic debt. Okay? There is a limit to how much you can tax people in order to make up for that. So you're left with these two options. One option is to sell down some assets in a manner that does not hurt your strategic interest. So sell down some oil assets, sell down some refineries, sell down some of the assets owned by the government in a transparent manner that gives you value. You can even have options to buy back later, or you can have golden shares, but basically raise revenue, raise money for Forex that way. And secondly, do what I've said, which is actually ask, what are the kind of incentives that you need to offer to private investors? And here I don't make a distinction between Nigerians and non-Nigerians. Frankly, I don't care about the nationality of the person who owns the dollars, if the dollars are going to come in. What I care about is what is the form of investment that's coming. This is what the chairman of First Bank was saying. So, for example, I'm worried about us turning ourselves into a market for textiles produced in China. But I don't have a problem with us being a market for Chinese companies coming to Lagos or Kano, preferably, to produce textiles and employ Nigerians and sell in this market to create jobs and pay taxes and grow the Nigerian economy. So it's nothing against China or the Chinese, but certainly whether it's a Chinese or Nigerian or American, if you're going to take production outside the shores of this country, and turn this economy into a consumer market, that is not the model that you want to encourage for development. And I think when we get to a point where we welcome investors of all nationalities who are willing to set up production processes here to turn our own raw materials and intermediate products into, and Ethiopia has done that extremely well. I keep saying Rwanda has done that very well. Kenya has done that very well. So, I mean, if you go to Ethiopia today, the Chinese are producing shoes and gloves right there outside Addis Ababa and exporting from Ethiopia. Okay, look at what they've done with their coffee. It's amazing. Okay, there's nothing that we're saying that hasn't been done by other African countries. There's nothing that we are saying. In fact, the model that we're advocating is that we go into the investment-driven model. I mean, China itself has grown based on investment over the last few years. That model has reached its limit. It's now rebalancing and moving towards a consumer-led, consumption-led growth. We have the opposite problem. We have had a model that has been driven by consumption spending and consumer demand. That model has reached the limit. It is time to move into an investment demand-driven model. So I think just understanding the broad macro issues, and that's what you call your story or your roadmap, okay? Recognizing that this is an economy where we have, and let me give you another number, we have over 160 million Nigerians today. The median age is 19. In the next 20 years, you're going to have 80 million Nigerian young men and women between the ages of 20 and 40. Any model that is dependent on the government taxing and paying salary and employing civil servants is not going to provide jobs for these people. Any model that is xenophobic, that tries to chase away foreigners, is not going to create jobs for these people. Any model that has an aversion to people making legitimate money and paying taxes and working hard and showing initiative is not going to provide jobs for these people. And this is the story we have to say. We need to create, our story is that we want to be an economy that provides an opportunity for these 80 million young people. And that story is a story of macro stability, and that includes clarity and transparency in central bank communication. It also includes independence of the central bank. So, I mean, I was very pleased yesterday, like I said, when the central bank came out. I was waiting for the MPC. I mean, I like the finance minister. I love the finance minister. But when the central bank said, we are not breaking down the rules, I said, yes. You know, that is what I like to see. So hold on to that. There will be a time when rates will come down. But let us, first of all, attract the forex. Let us attract the capital in. Let us stabilize the foreign exchange market. Let us improve the liquidity. Keep those factories open. Let them have raw materials. And then we can begin to look at credit, because you first of all have to make sure that you fix the transmission mechanism. If you don't have electricity, if you don't have, and the government doesn't want to fix security, we need the electricity, we need the infrastructure. As you do that, then 50 basis point, 100 basis point reduction in interest becomes a major multiplier, has a major multiplier effect through the credit channel. So I am someone that's, I'm generally very positive in my outlook. I believe that if people take the right decisions, they will see the right outcomes. 3-4 months ago, I was extremely pessimistic when the policy position was, we will not change. Okay, the last 3-4 weeks, I've been remarkably surprised. I mean, I've seen change. I have seen people call economists to talk to them. I've seen people begin to accept that they may have made mistakes. They're still sensitive to criticism, which is normal, which won't stop criticism. But I can see, okay, that there's a general recognition that this economy is a big problem and we need to face it. And frankly, we must remember that this government inherited a real mess as well. I mean, I was there. I know that the reserves that were left in 2015 should have been much higher if we didn't have the kind of leakages that we're having. As far back as 2013, I told the government, look, this is where we are. This is where I think reserves should be. These are my numbers. I think we're losing about $1 billion a month. If we don't do something about it and the price of oil falls, we're going to be here. That did not happen. So we are also paying a price for the profligacy and recklessness of previous years and for the silence of Nigerians when all this was happening. We must bear that in mind. We must also bear in mind that certain responses have been suboptimal and they have exacerbated the situation. Now we are getting the right responses. We need to have the courage to continue. And for God's sakes, the private sector, the economists, as Nigerians, we must continue to speak up and give constructive criticism and advice and point the government in the right direction. And policymakers should listen. Now, people might be irritated a little bit. It doesn't matter. If you're irritated or annoyed and you take the right decision, that's fine by many of us. By many of us. But I think the goodwill is there, the intention is there, and I listened to Ike. I'm actually far more optimistic given what has happened in the last few weeks than maybe when this report was written. Obviously, this was in the doom and gloom period of there will be no change. But I think we are heading in the right direction. So on that positive note, because my friend Wale Edun was begging me not to speak and not to create a new headline, and this was why I didn't want to come, because if I did come, I would talk about the economy. But I hope that what I have said represents a fair and sincere and patriotic analysis of the situation. And frankly, I think it is not an impossible situation, but it is difficult. It will need intelligence, it will need transparency, it will need courage, and it will need consistency. If we have those four, I think we'll get out of this and we will be better off as a nation.